Hi, welcome to the Village Trader Podcast. I'm your host, Njabulo Nsibande. This podcast is aimed at helping new and experienced traders navigate the markets and learn from other traders. This is episode number 33. In this week's episode, we're chatting with Trend Trader, a Chartist, YouTuber, and a trend follower about his experiences trading the markets. Please do enjoy our conversation. Good afternoon, Mr. Trend Trader. Thank you for borrowing us your time, man. How are you doing?
Hi, man, I'm good. And you?
All is well, man. Can't complain much. Can't complain. Yeah. Man, let's just get straight into it, man. Take me through your story or your journey into the financial market, because as I understand it, you're not a finance or economic major by profession.
Yeah, man. Okay, so I have a chemistry background. Basically, I have a science background. And then around 2015, I opened an account, a unit trust account with Standard Bank and Stanlib. So there I was just investing in unit trust. So now, when you see the price go up and down, you've got a long-term goal that you're going to make some money in the long run. But then you start to see the day-to-day fluctuations, and then you start to think, okay, maybe I want in of that action as well. And then in September 2015, I think Financial Mail had there was a cover on Purple Group. Yeah, I think the September Financial Mail magazine had a special on Purple Group. So that's when I first came into contact with Easy Equities and the other companies under the Purple Group umbrella. So from there, I decided to open an investing account with Purple Group with Easy Equities. Then I started investing in shares. But there, when you begin, you are just an amateur. You just a quick Google to see what's in there and everything. I made most of all the rookie mistakes that people make. For example, I read somewhere about penny stocks. They looked attractive. I bought some companies just because they were selling cheap in terms of rent value. And that, I remember at some point, then you start reading about Warren Buffett and everything, how to do analysis, fundamental analysis. But that was just beyond my thinking capacity, because I thought it required a background in finance. But yeah, so I just kept on adding onto that Easy Equities account. Then in 2016 January, I think then I decided that, okay, now it's time I try CFD. So I opened an account with GT247. I tried a lot of up and downs, a lot of accounts that I bent there, because literally I was clueless. I did read some books and some quick search, but there wasn't much information that I could understand. But something that helped me a lot along the way, as I was Googling, I think I found Rainer Tio's website. So Rainer Tio has a nice PDF document, The Ultimate Guide to Trend Following. So I read that document. I saw that, okay, this looks like an easier approach. It's something that I understand. It doesn't talk about finance. I just look at price and stuff. So now, once you start to follow one person, one trader, for example, once I started following Rainer on Twitter, then you start to see a lot of other trend followers popping on your timeline. I think the other person that I followed at the time was Assad. I think it's Assad Thanos. He's in Australia. He was also doing trend following. At that time, he used to post charts. So when you see those charts and everything, and it works, whenever he gives updates, then I thought, okay, this thing works. Even then, I thought I had a hang of it. I tried it a bit. There were some good results, but they were inconsistent. And then eventually, I bought the book Trend Following by Michael Covell. Yeah, that's my holy Bible, if I can put it like that. So I read Trend Following. In Trend Following, there are some things that I saw there that started to make sense. For example, I didn't understand the difference between risk and volatility. But in that book, it explained nicely what is risk, possibility of a loss, what is volatility, the rate of change in price. And then you start to see different interviews, like the guys, I'm not sure if it's men AHL, but they are physicists in, I think it's United Kingdom. So you start to see a lot of people who don't have background in finance, making money and stuff. Then I read Trend Following. Then I started to read other books by Michael Covell. I think I read The Turtle Trader. I don't remember in terms of order. But when I read The Turtle Trader by Michael Covell as well, what struck me there was that Richard Dennis, I forgot the name of his partner, to show that you can teach anyone how to trade for as long as you can give them a set of rules that they have to follow. So that sort of helped me a lot to get an understanding of trend following and systematic trend following, just a rule-based approach. But you know, I don't know if you probably know Steve Benz from Twitter. You usually see that yes, you see that Venn diagram showing risk management, psychology. I think the other one is a trading system. So now you see, you think, okay, now I have a trading plan, which I can call a system. And then the system also incorporates risk management. You think, okay, now I have this thing. I know when to enter, what to buy, how much to buy and stuff. But in terms of the mindset, are you really there? Can you handle a loss, or you're just convincing yourself that you can handle a loss? So at some point, I read Trading in the Zone. I think it's by Mike Douglas. So that book for me was a game changer, because then I found the key missing link to fulfill or to make my Venn diagram complete. So now I knew that I don't need to know what the market is doing in order to make money. What happened previously doesn't mean anything. I don't need to know what will happen next. I need to know the difference between knowing risk and accepting risk. So then my results started to be consistent. I mean, yes, trend following works. My result can show that trend following works. A lot of people have evidence that it works. Yeah, so that was more, I was trying to trade Forex with that knowledge, some futures like NASDAQ, S&P 500. I've never traded a top 40 or the all share index. And then I use that knowledge to trade stocks. I'm still using easy equities, but I do the analysis on the side and then buy the stuff and sell the stuff on easy equities. And then I think it was 2018, I first heard or saw a guy named Mark Minivini. Then, hey, look, this guy has a blue book, demand super performance, what. Then like, okay, let me get myself this book. So in addition to Trading in the Zone, the book by Mark Minivini, the first book, blue book, I don't have it. I only have the black book in a hard copy. Yeah, that was another game changer, because now I saw a lot of things, how to trade stocks. That was the first time in my life I realized that 100% return is possible. You just have to know what is happening in the market in terms of the market phase, and then buy. Either you're buying certain chart patterns and then the results start coming. So yeah, since October 2018, I've been applying that knowledge. And after I had read the blue book by Mark Minivini, the black book, I just bought it because I enjoyed the blue book. But at that stage, I just told myself that trading or if I really understood what the books or the knowledge was giving me, the result will show that. If I can't crack it, it means that my skull is a bit thick. So yeah, those were the books, but the people that I can say they helped me a lot, it was finding Rainer Theo's material, which then led me to Trend Following by Michael Covell, and a lot of the books by Michael Covell, and then the Mark Minivini book. the Blue Book, and then Trading in the Zone. The other book that helped me to just open up my mind and not to be ignorant in terms of strategies is Market Wizards by Jack Schwager. So yeah, what I saw in that book is that different approaches work for as long as you know what you are doing. For example, the people who use fundamental analysis, just exclusively fundamental analysis, they make money. There are people who use technical analysis exclusively, they make money. There are people who mix it. There are people who trade different securities, they make money. So this thing of wasting time arguing with people on whether Elliott wave theory works or it doesn't work, Fibonacci works, it doesn't work, it's just pointless.
Yeah, I agree.
Yeah, so now I just focus on trading and then applying what I know. I still use systematic trend following. Yeah, so those are the books that helped me to develop a trading approach. Then there are other books that you just read, I guess, to see other people's experiences, like the Reminiscences of a Stock Operator. Yes, it does has an element of trend following, but I think it's a nice book just to see how other people handle trading. And also the book by, I think it's Nicholas Davas, How I Made 2 Million in the Stock Market. It also has a trend following element, even though at the time, I will just say maybe according to Michael Covell, at the time, trend following wasn't known as trend following. But yeah, now I just read trading or investing material for fun, not necessarily looking for strategies.
Oh, got you. And that was a very, very interesting story and journey, man. I did enjoy listening to you doing that. Quickly before we touch on your strategy and your system and your systematic approach, are you still long only, or now you trade both uptrends and downtrends?
Okay, because now I only have an account with Easy Equities, I only go long. But it's also worth mentioning that there are South African traders and investors that I follow on Twitter. I think one guy that is worth mentioning is Kos. I don't know if I will pronounce his surname right. I think it's Kos Kanma. At some point, he kept on tweeting chat, but that was a long time ago, probably 2017. I asked him if he does long and short. He just said he's only on the long side. But in my case, it's because of the limitation that I have with Easy Equities. Well, I've tried to trade CFDs. It's not something that I enjoyed, but at that time, it was mostly because I was inexperienced. But so far, it's just long only. I have a CFD account with GT247 where I trade Nasdaq, S&P 500, the European futures, oils and stuff. Yeah, whenever there is something that is on a downtrend, I will short it because there I have that option. I don't trade Forex. The short answer is just that I suck at it. That's the only reason why I don't trade Forex. Yeah, because with trend following, I can trade futures market on a daily chart without a lot of worries. I think the volatility there I can handle. As much as Reina has tried a lot to have a lot of material showing that you can trade Forex on a daily chart, I'm not there yet. I'm not comfortable trading Forex on a daily time frame. I can't use a lower time frame because I have to be somewhere during the day. So the daily time frame works best for me. But yeah, so to answer you, for now, I'm just going short, long, always.
Yeah, man. You're not the only person suffering when it comes to trading the FX market, and I don't trade FX purely because I hate continuous markets. I want to sleep well at night knowing that nothing is happening on the market. When I'm trading the GAC stocks, I know at 10 to 5, the market goes into the closing auction. Then at 5, everything stops. So I like that quite a bit. So, man, take me through your strategy when looking for opportunities, or your system rather, when looking for opportunities in the market.
Okay. I used the daily time frame, and then I used the moving averages. Okay, I use exponential moving averages. I don't even know why I use exponential moving averages. But yeah, it's just maybe to try and be consistent and not shift between simple moving average and exponential. So it's the daily time frame with a 200-day exponential moving average. The volume indicator, I use it just to check the breakout if it has a bit of a momentum there. And then I use the average true range to estimate the volatility. So there I'm just following the teachings from the title trader and also the teachings from Rain. And then I use the 200-day exponential moving average for sort of a bias. If the price is trading above the 200-day moving average, then I'll be looking to go long in that security. I don't touch anything that is trading below the 200-day moving average, irrespective of the story. Just to make an example, when Sasol was trading below 200-day moving average, and then I think last year it went to the 20 rand range, there were some comments, people saying that Sasol is a great company, it will recover and everything. I just didn't buy it at 20 rand because that was against my rule. So my rule for entry, the stock must be trading above the 200-day moving average. But then I will look for prices when they cross the 200-day moving average. I like those entries because they give me a much better risk to reward. So I will just estimate the stop loss using the ATR. I think now I use 1.5 ATR. At some point, I was using 2 multiple ATR. Okay. But with 1.5 ATR, if I'm buying near the 200-day moving average, usually I get a less than minus 10% price decline as an exit. And then, yeah, once the stock starts trading above the 200-day moving average, I'm not very good with patterns. But I mean, as time goes by, you start to see whether it's a bullish flag or maybe inverse head and shoulder or cup and handle pattern. Yeah. But once the stock is above the 200-day moving average, and then I will look for other potential breakout either from the previous resistance and stuff just to add on the position whenever it forms a base. So my entry criteria is stocks that are breaking above the 200-day moving average. I like to enter as soon as they break and close above the 200-day moving average. And then if I miss that opportunity, I will wait for the stock to retrace back to the 200-day moving average. Then I will buy there. It's another area of value. If the 50-day moving average is now above the 200-day moving average, I will wait for pullbacks to the 50-day moving average to add on to the position. So if there's a pullback, I will add. But if the stock is moving upward strongly, I will just look for breakout at certain key levels. Either it's breaking out on the previous resistance and stuff, then I will add there. And then also, then I will search for companies that have reached their all-time highs. So if I find a company that is trading at an all-time high, I will look where I can enter with a sort of fair risk to reward. For example, I will look if the stock will consolidate a bit, and then if it break out of that tight range, then I can buy because it's easy to have a stop loss below that tiny range. And then stocks that are on their 52-week high as well. So usually anything that's reaching all-time high is above 200-day moving average. Anything that reaches a 52-week high is most likely above the 200-day moving average. Yeah, so it's those all-time high, 52-week high, 200 exponential moving average breakout, pull back to the 50-day moving average. That's what I use. And then to exit, I always estimate from my price of entry. Then I look for an area of value, either as a moving average or a certain pattern, whether it's a tight range, a bullish flag, or in a cup and handle. Look where I can place my stop and then use 1.5 ATR there. And then I use position sizing just to make sure that I buy enough that I don't blow more than 2% of the total portfolio. Yeah, so now because it's still a small account, I risk 2%. Yeah, but I was telling the other people that I usually talk to that the 2% is just a value. You have to ask yourself the value in rand terms. Can you handle to lose that amount in rand terms? Because it's easy. If I say to you, I use 2% and you are trading 100,000, it's different than when you're trading 10 million. Can you handle a 2% on a 10 million rand account? So it's a different story. But yeah, at this moment, that 2%, it's something that I can handle emotionally. Then, man, once I've set my stop, as much as I don't have the option to set a stop level on these equities, but I still check the stuff that I bought. It's either I'm using investing.com for charting or I'm using TradingView. So I will check my positions probably once or twice per week. Well, it's not easy to just neglect them because I'm a trader. I'm not an investor to say I will just buy and forget. So from time to time, I have to check because there are some alerts that I have to check if the stocks are performing the way that I was expecting them, if the price levels that I'm paying attention to have been hit and stuff like that. Then yeah, that's it. If the stock is above 200-day moving average and it's on an uptrend, a series of higher highs and higher lows, I'll just hold that stock, ride the trend. I don't set take profit levels. The only time I exit a stock if it's on an uptrend, if it closes below the 50-day moving average, then I will close that position. That is not to say that that is not to say that the trend has ended. There were times where I kept positions. Sometimes you look at the distance between the 50-day moving average and the 200-day moving average. If you feel like the 200-day moving average is going to provide some sort of a support, but that gap is just wide, 10%, 20%, I don't think it's worth it for me to hold that stock. I would rather sell, wait and see if the stock is going to continue to trade lower until it finds support in the 200-day moving average. If it does find support and show some lower price rejection, either based on the candlestick patterns, but basically for it to close above the 200-day moving average, then there's no harm in taking the position again. Even there on the 50-day moving average, if it closes below, consolidate for some time underneath the 50-day moving average, and then at some point it closes above it, I will still buy it because that will be another buy signal. But yeah, the only time I exit a stock is if and only if it closes below the 50-day moving average.
Also, so the 50-day exponential moving average becomes almost like a trailing stop on your positions.
Yes, it becomes a trailing stop because on easy equities, I can't set the trailing stop. But on MetaTrader with the GT247 futures account, there I use a 1.5 ATR trailing stop. Yes.
Oh, okay, got you. So, man, you touched a bit on risk management and the 2% rule. And I like that you make emphasis on 2% is low enough for your slipping point at the moment, and then I think it's something that is being touched on the reminiscence of a stock operator where Livermore says you need to sell down to your slipping point if the trade is too big for you. So with seeing that you're trading with easy equities, meaning you are not geared in your positions. How are you calculating your positioning size to ensure that no more than 2% of your account equity, notwithstanding that from time to time you'll suffer a bit of slippage on the market open volatility. How do you say okay, I'm entering stock A at 10 Rand and my stop is sitting at around 8 Rand or whatever the case is. Therefore, I'm buying 100 shares of the particular stock. How do you determine your positioning size to ensure that your risk management still adheres to that 2% rule, considering the fact that you're not geared on your position?
Well, I think if you're not geared, I think if you're not geared, relatively easier compared to when you are geared. But the whole calculation, I do it on Excel. So I have a cell that has the total account value, and then I have a place where I will put in the ATR of that particular stock and the current trading price of that particular stock. And then because let's say 2%, I know 2% of my account, how much it's supposed to be. And then I use the ATR and the price to determine how much I'm supposed to buy. And then now that will give me, usually it's just a lot of figures, but I then round it down just to account for the slippage. Let's say, for example, I'm just trying to look at this thing, but everything that I do, it's on Excel. It's easy. Yeah, it's easy if I can put it like that. Okay, now it's open. Yeah, so I have a cell that has an account value, another cell that has ATR, another cell that has share price, and the 2% risk. And then I multiply the ATR with the multiple that I'm using. In this case, I'm using 1.5% multiple. So basically, to calculate the lot size that I want, I use the value of risk. Okay, let's use a theoretical value of 50,000. 2% of 50,000, it's 1,000 rand, right? And then I calculate the ATR value, 1.5 times ATR. Let's say I want to buy Sasol. The ATR is 7 rand 66 cent. The share price is 142 rand 20. So the 2% risk in this case, it's 1,000 rand. If I say 1.5 times 766, which is the ATR value, I get about 11 rand 50 cent, right? Then I take the 11 rand 50 cent, I divide the 1,000 rand that I'm willing to lose to get the lot size that I'm supposed to be buying. So in this case, I'm getting 86.75. Okay, the figure is not 50K, it's just slightly above 50K, but I get about 80 shares that I'm supposed to buy. So now here's the thing, because it's not geared. If I were to buy 80 shares worth of Sasol, I need about 12,200 rand. You see?
Yes.
Yeah. So now, if I have that 12,000 there, I will just buy the total shares of Sasol worth 12,000 rand. And then my stop loss there is going to be around 131 rand per share. So now I know that if Sasol drops from 142 to 131 and I exit my position, I will only lose 1,000 rand. You see? And yes, I will only lose 1,000 rand. Then if you look at the risk in terms of percent, it's about minus 8%. So Sasol has to go down by 8% for me to lose. You see? So now when I look at my Easy Equities account, I can see that, okay, let's say Sasol, for example, drops to 135. Then I know that probably it's about 4%, it's down 4%. So I know that my position is still safe. Then as it goes to closer to minus 6%, then now I know that my position, I need to pay more attention to it. It's either I half it or I wait for it to reach minus 8%, then I close the whole position. But since this whole thing is not geared, there are challenges. As we said, we're using a theoretical value of 50,000. So if I spend 12,000 on Sasol, and then I get a signal, let's say on BHP Billiton, I do the position sizing, it requires 30,000. Then I buy BHP Billiton. So now I'm low on cash. Probably the next stock that I can take, let's say I buy Impala and I need 20 grand. Then I can afford to buy it. Then boom, another signal, there's Sanlam. Then now I'm out of cash. That's the problem. Not geared. Yeah. So that's the limitation towards it. But I mean, if I have 4 positions, each with 2% risk, then I know that if all position go south, the total portfolio drawdown is 8%. And then according to the risk of ruin table, I think if you lose 10%, you need about 20% to come back up. 12%, yes. Yeah. So you see, I can just come back quicker. But the advantage of position sizing, we'll go back to the Sasol example. It's minus 8% that I'm willing to take the drawdown, right? that it has to go down by minus 8%, but my portfolio, it's just 2%. So if Sasol goes up by 8%, I'm not sure if you are familiar with the R concept, risk to reward, and then it's presented in a form of R. Yeah. So now I know every positive 8% is plus 1 R, you see. So basically, if Sasol goes up by 20%, I have made like 2 times of what I've risked, you see.
Yeah.
So position sizing helps me to buy a lot, but to minimize the downside. The opposite of position sizing, well, I'm not saying it's the opposite because there are a lot of people, market participants, who manage risk different way. But if we're to approach this 2% risk this way, we know that the 2% of 50,000, it's 1,000 rand. You just take 1,000 rand, you buy Sasol shares, you forget about it. Whatever happens, happens. You've accepted that you are willing to lose 2%, right?
Yeah.
So Sasol has to go down by 100% for you to lose 1,000 rand, right? But also Sasol has to go up by 100% for you to double your 1,000 rand. That's the difference. Yeah. So with this position sizing approach, for me to double that 12,000 that I have invested, I don't need Sasol to go up by 100%. So it gives me that advantage.
Oh, gotcha. Yeah, that's a very interesting approach, man. I've always wondered how do people that are not geared manage their 2% risk?
Yes. Yeah, no, to calculate it, it's somewhat easy. But yeah, again, what is important is that you as a trader are willing to lose that amount of money. I'm just trying to look at this. So I'm looking at this book by Michael Covell, The Complete Turtle Trader. I think it's on page 89, where he shows the calculation of position sizing. But I mean, if you just Google position sizing, it comes out. I found it to be a very interesting concept that you can invest a lot of money. Like you can pull a large position, but only risking a fraction of it, you see. So basically, my focal point is on how much can I lose versus how much can I make, you see. So if I just throw in 30 grand on Sasol, but knowing that I'm only risking 1,000 rand, I can sleep better at night than to take 30,000 and say I'm putting this on Sasol. If I die, I die. Yeah, literally. I think I will end up dying.
Yeah, I've actually written a piece on positioning sizes. I'll put that link to. I'll put the link to that in the show notes below. Once this podcast, if I can find words, that this podcast is out. Do you put?
Okay. Oh no, I was saying that, for example, at some point I read about calculating the intrinsic value of a stock and then to see if it's undervalued and everything. Then in the end, you get the intrinsic value. You look at the current trading price and then you decide if that's enough sort of buffer as a stop loss. Now, what I always want to ask my friends who do fundamental analysis, let's say you calculate Sasol. Sasol is trading at 165. You find that the intrinsic value is 140. So you have about 20 rand buffer. Then you buy Sasol because you accept that risk. What happens when the share price of Sasol fall and reaches 140? Do you then exit or you don't exit? I think that's what separates an investor from a trader or a technician fundamentally. Because from a technical perspective, once the price hits a certain level, it means that whatever I thought the stock was going to do is wrong. So I have to exit. I don't have to justify it and say that Sasol still has the buildings are still CEO still great and everything. Yeah, but I mean that's just the silly politics of who are doing something that is different to technical analysis.
Yeah. I know that you're a technical trader and not a fundamental trader. Do you put any sort of consideration to the fundamentals of the companies that you're trading?
The short answer is no. And that has its limitation, trend following, right?
Mm-hmm.
So now how am I going to add a discretionary decision such as Sasol now changes the CEO, they bring in a rockstar CEO. How am I going to add that into my trading approach? So the only thing that matters to me is price and its relationship to the moving averages. Those are the only two things that I look at. But I want to be honest with you and say there are limitations to it. Right now, I was looking at the property index because you learn every day. Some things, they start to make sense as you trade and everything. It's easy to look at ETF, just an individual ETF, or maybe an individual stock in the property sector. Let's say I'm looking at Redefine. I see Redefine just crossed and closed above the 200-day moving average. Then I want to buy Redefine because the system says so. I buy Redefine. Then at some point, it clicks on me. Wait, we are now currently experiencing the pandemic that we're experiencing, the coronavirus diseases. Most of people are working at home. Nobody's renting space, you see. So now you start to think most of the real estate investment trust, they are geared. So if they don't have tenants, how are they going to pay the interest and service the debt and everything? If they're not generating money, how am I going to get money? Yes, the chart says it's a buy. So now you see it's something that you see in the end that, okay, this thing blindsided me. Because if I was a fundamental investor, or if I considered fundamentals, I would probably looked at the balance sheet of the company or all the financial statements that people read and make sense out of, and then look at what is happening around. Are there people renting space? Are the tenants able to pay rent and everything? To just pure technical with any fundamental thinking, my result stays the way that I want them to be. There was a time last year I got a signal on Tiger Brands, I got a signal on AVI. I think those are two different companies on AVI. Then, because now I was running low on cash, I wanted to decide if I should invest on Tiger Brands or invest on AVI. Then I started to look at things such as the balance sheet and the dividend yield. I sold half of my position on Tiger Brands and bought more of AVI. Then AVI started to trade below the 200-day moving average, whereas TPS maintained its trend above the 200-day moving average. So then I realized that, okay, I've been using systematic trend following without diluting it with fundamental analysis. Not to say that there's something wrong with fundamental analysis, but if you keep on changing your approach, then you will get different results. So now I just decided that I will stick exclusively on technical analysis. And then on the channel Trend Trader, where I just use technical analysis, there's another channel that I'm using. It's called Mzansi Investor. It's there on YouTube. And Twitter handle, I think it's also Mzansi Investor. Because people are more tilted onto the investing side of life as opposed to the trading side. So if you want to talk to the general public, you make more sense if you talk about investment rather than when you talk about trading. Yes, when you talk about the people that are trading, they understand what you're talking about. But the general public, the people want to put some money on the side and use that money to make more money. If you talk about investing, it makes sense. So I decided, okay, I will have a separate channel and then I will incorporate dividend yield. Because if you tell someone that you look at the dividend yield and the dividend income, because with trading, I look for growth. Whether the company pays dividend or not, it doesn't really bother me that much. What matters is that the price is appreciating. Whether they pay dividend or not, I don't focus on that. If I get a stop, let's say, for example, I have a high prop position and they're going to pay a dividend this coming Monday, but my stop is hit on Wednesday, the week before. I will exit my high prop. I'm not going to hold the position just so that I wait.
Okay.
Yeah, you see. And also to understand how the dividend yield is calculated, there's that annual dividend, I think, divided by price. So the price changes every day, but the dividend that they paid doesn't change. So if I look for any stock that has a dividend yield that is greater than 5, each day I will get different answers. But there I cover stuff that are less volatile, like ETFs. Then I will compare ETFs in terms of dividend yield, ETFs in terms of total expense ratio, the stuff that makes sense to the general public. And then maybe if I buy a stock, there I always say technicals first. First, the stock has to get my attention based on technical analysis. Then I will look at the dividend yield to say, okay, now I got a signal for Old Mutual, and then Old Mutual has this dividend yield. So if Old Mutual stay above the 200-day moving average, for as long as it stays and the dividend yield is this much, then I can expect Old Mutual to pay me this much in the form of dividends. You see?
Oh, gotcha.
Yeah, but for my trading approach, pure technical.
No, okay. I know you and I are the same, man. I'm just purely technical. I don't care what the company does or the sense announcement. Sometimes it hits me on by the backside. Sometimes it supports me, but that's neither here nor there.
Yes.
Take me through your best and the worst trades that you can remember from, and what were the lessons from each?
I think my worst investment, if I can call it an investment rather than a trade, was with MTN. So October 2015, when I just opened my Easy Equities account, I saw MTN. It's one of the big companies. I'm using MTN as my service provider and stuff. Then I just bought MTN. I think at the time it was trading just above 150, not sure 155 or what. On the day that I bought it, we were in the meeting, so I bought it in the morning. Then somewhere during the day, they announced, not sure if it was a fine, but it has something to do with Nigeria. Then the share price started
rand fine or something.
Yes, the share price started falling. Because now I'm just starting, you read things such as rent cost averaging, buy more, buy when there's blood on the street and everything. I kept buying MTN all the way from 150. I think I just bought at the top, 150. And I kept on buying 140, 130, 120, up until I couldn't take it anymore. I kept my position. So that's one of my worst investment. I still have debt just so that it reminds me to never repeat that mistake ever again. The other one was Braid, the company that owns Virgin Active. I don't even know why that one started falling because I thought, I'm a physically active guy. I go to Virgin Active. The other stuff that is under Braid, I think the other company is a
New Look.
Yes, there's New Look. There's the other company in Iceland. And yeah, then I think this is a good story. Then I buy. There's Dr. Christoph Wiese there. You see ShopRite, you see Pep and everything. If the guy's name is there, that thing is going to be great. You see? So I bought Braid. Also, Braid started falling. I kept because, the saying on the street, you only lose when you sell. So I had to hold my loss. The other one was Blue Label's Telecoms. That one, when I bought it, I think I started buying it at 14 Rand. And then it started going up. I didn't know why it was going up. It started going up from 14 Rand. I remember at some point it reached 20 Rand per share. Then there was a time when they sponsored, I will just say they sponsored Springbok, but their name was on the Springbok shirt. I remember there was a time I told my girlfriend, look, Dali, this thing now is going to get public attention. People watch Springboks, they will know telecoms and everything. And, all the stories you read about the guys, the founders of Blue Label Telecoms. At that time, I was also selling airtime. I was using a blue machine. So I know every week I go to deposit money there because I sell airtime and everything. So, yeah, those were some of my worst investments. Yeah, because whatever strategy I thought I had, I just didn't have a strategy. I was buying what the gurus on social media are pushing. And then I was backing it with some very, very horrible research that I was doing. And then they didn't work well. At some point, you can't handle it emotionally. Then you have to cut it and then start afresh. And then my best investment, but that now was trading, because at that time I had already read Trend Following by Michael Covell. I had read Mark Milligan's book. I saw Impala. I think it was trading around 22 rand per share. I think it was November 2018 at that time. I bought Impala. It traded there from 22 rand to about 27 rand. I think it retraced a bit. When it came back to break above 27 rand, I added on that position. It just kept on going, 40 rand, 50 rand. With every pullback, I added on the position. That position went up, I think, not sure if it's 150 or 170, just before Corona hit us last year in March. Then I exited that position. That was one of my very best trades, using technical analysis, systematic trend following approach.
Yeah, it went as high as around 170, 180.
Yes, that one really filled my my pockets. The other one was Telkom. I just want to see which level Telkom broke. But also Telkom, it just broke above the 200-day moving average. Yeah, I wrote that trend. I'm trying to find it. Yeah, it was also somewhere around 2018. It was trading around 52 rand per share. I held the trade all the way to about 100 rand per share. Then it started to pull back, and then it closed below the 50-day moving average around 8 rand per share. Then I exited the position. So yeah, those were two of my best. And then last year I had Nsibande. That one gave me a nice 100% return, because I bought just after it came back to trade above 26 rand after that fall, the COVID fall. So I held that one all the way to about 60 rand. In fact, I still have some bits and pieces of it. So yeah, so that is why now I can comfortably say that trend following works. But I mean, man, what just gave me an idea, or sort of confirmed that this thing works, is that as long as you are looking at something that is trending, and just ride the trend. Trend following is not going to work in a ranging market. If you can't distinguish a ranging market from a trending market, you're just going to burn your fingers. That's it. Yeah. So you have to always look for something that is trending and be disciplined enough to sit out something that does not resonate with your approach. But another trade that worked well, even though according to my books, it was a bad trade because I didn't follow my rules. It was Sasol. So after Sasol fell all the way to about 20 rand per share, sometime around May, it closed above the 50-day moving average. But the 50-day moving average was still below the 200-day moving average.
Yeah.
And then I had seen with other stocks, because I mean, like I said, if the price is trading above the 200-day moving average and it's above the 50-day moving average, if it closes below the 50-day moving average, the chances are it will go and test the 200-day moving average, fight there, and then go up. So the way that I approached the Sasol trade was that, okay, now Sasol has closed above the 50-day moving average from the bottom. The next resistance level is the 200-day moving average. So if I buy now and set the stop just below the 50-day moving average, if Sasol pushes all the way to the 200-day moving average, I'll be able to capture that move. And it did. Yeah, I think it went as high as 180 rand per share. Then I closed that position. Luckily, remember, in my case, I always leave a room for pure chance.
Yeah.
So I closed the position. Then the following day, it started to go back below. But then again, I expected it to continue to trend lower because it hasn't traded above the 200-day moving average.
Yeah, in fact, it did that for the first time, I think a week or two ago.
Yes. So now that was a profitable trade. But since I didn't follow my rules, it was a bad trade. I told myself that, okay, it worked, but I shouldn't do that a lot because not all the companies, they will be able to survive above the 50-day moving average, whilst the 200-day moving average is still trending lower. And then after I had exited that position, I never touched Sasol until not last week, the week before that one, when it just closed above. Then that's when I touched Sasol. So I have a friend that I talk to a lot about. He's more into fundamental analysis.
Mm-hmm.
So we'll talk about good companies and everything. Yeah, so now with my approach, Sasol is above 200-day moving average. Then I can start listening to stories such as Sasol is a great company because the fundamentals, the technicals, I mean, they support that story. I will buy it from a technical perspective. So all the smart guys, the smart money, if they see that Sasol paid the debt, things have changed, they sold the bits and pieces of the Lake Charles thing, you see, they will invest from that angle. I will buy from the technical approach. In the end, we're all gonna win. We see it from different.
Yeah, you'll run the win.
Yes, we're all gonna win, but our reasons for winning are completely different. You see. Yeah, so those are the traits. The MTN, Braid, Blue Label Telecoms were my worst performers. I won't blame Purple Group when it was trading, I think, at 50 cents per share. I just didn't know. I was looking for something that is selling below R1 per share. I mean, you think that if it's worth R1, you buy a lot of it. If it goes to R2, you double your money. Yeah, that's not a great strategy. It works, but it doesn't work. I mean, you look at Aveng. Aveng has been trading between 1 cent and 3 cents for the past 3 years.
Yeah, that thing is going to zero.
Even if you put R1 million in there, you would have missed a lot of opportunities. Yes, you will be a biggest shareholder of Aveng shares, but there's no show for it, you see. Same with Steinhoff. When it started falling, I managed to sit it out, I think, for about 3 years or so. I just set it out. Yeah, just because it costs less than a cigarette, it doesn't mean that I have to buy it. I want to buy something that is moving. I want to buy something that is moving, not something that is dead. So, yeah.
Yeah, and then incidentally, one of my best performers in my not in my trading portfolio, in my investment portfolio, has been Purple, because I've started picking Purple around 28 cents, and I've been adding to that position since I started buying it, and I still continue to add into that position into Purple. I just like the company, and I think in my mind it's going to be the next Capitec because it will it does what Capitec did with banking, except it does it with in the investment world, and I think the market will catch up to it in time.
Yes, yeah, I know. There, I won't lie. Purple Group has a great story. It's a very interesting company. I like what they are doing. I mean, I use them. I'm their client. I'm happy with the brokerage that I'm paying with them. Sometimes there are some minor glitches there and there, but you just you can be able to talk to them and they can fix some of the stuff and everything, and they keep on improving their platform, if I can put it like that. For instance, when I started, there was a 15 minutes price delay. Now you have an option to get the live price.
The live pricing,
It's affordable. I mean, for 20 rands, you can get about 250 credits. So it's not a lot. For me, it's worth it. Today, I got an email about trade alerts, or just alerts, not trade alerts. So now you see it's continuously improving. So the company itself has a great story. And recently, the chart also tells that story, because I will always look at the chart first, then make my decision. I also have a bit of Purple Group in my portfolio. It's not a lot, but the reason I have it, it's because the chart says buy this. Then I started accumulating it.
Got you.
So for me, I'm not gonna lie, bro. It's always gonna be the chart.
Yeah. And I think it was Simon that says it doesn't matter what you think, price is the only truth, and
Yes,
chart will give you the truth, because the only thing
yes,
that the chart is giving you is price, and then you then add derivatives of price and moving averages or oscillators or whatever the case is, just to interpret what the price says or what the price means. But the
yes.
price is the truth.
Yeah, I know the price says everything because even if there's a guy who's cooking the books, the price is just there. By the
Yeah.
time they report that somebody cooked books, probably they, you see, here's the thing. Yes, insider trading is illegal, but we are human beings. I don't expect somebody to know that a company is going to be profitable and not somehow tell
Buy it.
someone. You see, so now if the company is gonna do great or it's gonna do bad, if it's gonna do great, somebody's going to buy. It will show on the chart.
Yeah.
If somebody's selling, it will show on the chart. So as soon as I see something that is close below the 50-day moving average, I will sell. Whether the NPA is investigating, the company is doing this and that, by the time the story is out, I would be out of the position as well.
Yeah.
You
Yeah.
see?
Yeah. True.
So
True.
I just believe it, that somebody always know somebody will do something, and that something will be reflected on the chart.
On the
And
price.
then
Yeah.
what I see from the chart, make a decision there. For example, you will get what was this company? But I just bought Sasol because it closed above the 200-day moving average.
Mm.
Then, boom, there were news that they had paid a portion of that debt. You see, so now somewhere out there, there is someone who probably bought Sasol because of the debt payment. Then the price moved up. I bought Sasol because it closed above the 200-day moving average. So now you see the news and the price action are now working in confluence. I'm seeing something there. So,
Yeah.
but I
Yeah.
didn't need to know whether Sasol paid or not. Yeah. So
Yeah.
for
Yeah.
me,
True.
price first, cut first, and stuff. Yeah.
Yeah. True. So, as someone that has fair that experienced a fair amount of, you know, failure, for lack of a better term, and a fair amount of success in your trading career over the years, to your mind, what differentiates between the loser and the winners in the financial markets, when at least specifically when with regards to trading the markets over the short term?
I will say it's the mindset. Uh, as Michael Douglas put it, there's a difference between knowing risk and understanding
Accepting.
risk. Is so if you accept risk, it's easy for you to take risk because you don't just take any kind of risk, you take calculated risk. You
Mm.
see, so now you know that at some point you can part ways with a portion of your money, and if you are at peace with that, you're just always going to be positive. You're not going to stop buying stocks just because there were some losers and stuff. You know that you are going to win. And Mark Minervini, obviously, he's already rich. It's easy to talk from his perspective to say, if you want to win, you're just going to win. I think I read somewhere that some people, they are just so used to losing, like sort of they have an attachment to losing, that winning to them is just foreign. They don't accept winning. They just looking for losing. If they lose, it makes sense, you see.
uh,
So now, based on the strategy, and because now it has a quantified edge, I record my win rate and the size of the winnings and everything. Then I calculate based on the formulas that I find on the internet. The strategy has a positive expectation. So I know that whenever I place a trade, it's more likely to be a winner. It's coming from the fact that the strategy has a positive expectation, and also because let's just use the 200 exponential moving average breakout. Out of 10 positions I took using that strategy, about 8 of them, they worked. You see, so if there is one that does not work, I can handle it. And because I look at how much I can lose versus how much I can make, I know that I'm prepared to part with 2% of my portfolio. But if 1 or 2 trades they work and they give me 30% and the loss is 8%, so I have about 4 times R, you see. So in the end, I'm just going to win, you see. But I don't need to be cocky. I need to always be disciplined, be able to sit on the side. If I see the village trader post something on Twitter, or if I see, another guy, shout out to Lester David, he's one of the best in the game, and the team at Storm Trading. Those are some of the guys that I followed. You see, Storm Trading, they will post the winners, they will post their losses. You see, so now you see that if you lose, you are not the only loser. If you win, you are not the only winner. You see, yeah. So now, you just see other people's perspective. Somebody will post a chart. If it doesn't fit my entry criteria, I'm able to sit it out. Yes, it's nice because you're not gonna always look at all the 300 plus stocks that are there in the GSE. If somebody posts something and it's not there on your watch list, then I can just pull a chart and say, okay, there it is. This person sees this is what I see. If I see something that can give me a signal in the near future, then I add it on my watch list. You see? And then also to always stick to your plan. Be open to other perspectives, other people's views. I have a friend who uses Elliott wave theory. Yeah, I call that guy a wizard because, I mean, if he says the stock is going to go there or a currency pair, it just goes there. But yeah, I struggled to understand Elliott wave theory, you see. So now if this guy show me something, there's no need for me to argue with him and say, yeah, but my strategy says this. No, let him have that position and then see the position works out. And then let me see if I can learn Elliott wave theory. But just to cut the story, don't spend time arguing with people. Focus on what you see on the chart. And know that once you have a quantified strategy with a quantified edge, know that you have a positive expectation, you're going to win. One way or the other, you're going to win. And just focus on your circle of competence, if I can put it like that. I've accepted that I suck at trading Forex. So I don't even waste time trading, looking at the currency pairs. Yes, I can see that the US dollar versus the rand is doing this. I expect maybe the price continue, maybe it can reach 15 rand, but that doesn't compel me to say now, okay, let me activate Forex trading in my CFD account and take advantage into trading stocks and trading the S&P 500 and the Japanese futures and stuff. Yeah. So now some of the people, I won't call them losers per se. People who are just starting, they are just flooded with a lot of information. If you tell someone that the lowest a stock can go is 0, they will just tell you it's a great company, it will recover and come up with all these stories. And then each and every day, the price continue to trend lower and lower and lower, you see. Then obviously, if I tell them to, I won't tell them because I can't give financial advice. I'll just say I'm not going to buy this thing. And then they listen to the village trade. The village trader says you only lose when you sell. Now, this person is going to be holding this losing position because they don't want to take that loss. You see. Then eventually the loss becomes just too much. Now, when they exit, the total risk that they took on their account probably is 50%. Now, if you lose 50% of your account, how much do you need to gain just to break even?
You know, it's 100%. Yeah. True,
you see, so it just becomes difficult. And then once you start interacting with people want to see results. I noticed that my channel, I don't have a lot of subscribers. Obviously, I could be sucking at attracting people. But if I were to take a picture with my skorokoro, then people will see, hi, this guy, he was able to buy a car. Then they will start following you. Now it creates different expectations. If somebody asks me, okay, based on your strategy, how much do you think you can make in a year? Then I say, 20%, 20% is possible. Then they say, yeah, but there's this guy, village trader, he just make 100,000 in a day. Then like, yeah, it's like crossing the freeway with your eyes closed. You can cross it.
You might make
but
it.
How many times can you do? Yes. Yeah. So now, as you grow, you start to respect risk. You start to have realistic expectations.
Yeah.
You know what is realistic based on the numbers that you've ran. Yeah. Yes, some people, they can return triple-digit returns. I've done it before. It's possible. But I can't just take somebody who just started and promise them heaven on earth, because as soon as they lose on their first trade, then all of a sudden they're going to see you as a scammer, as an amateur and everything, you see.
Yeah.
But if you were to walk the journey with someone to say, okay, I'm providing mentorship to you, not to say you teach them trading. You just the mentorship. I will walk the path with you. I will tell you how I analyze stock, how I buy, how I place my trades and manage my risk. Just watch me for 3 months and see. If on month 1 I return 2% on the portfolio, total portfolio, that as much as I could return, because it's not my doing, it's the market.
Yeah.
All I have to do is make money, or I don't make money, you see. So now then people will start to see that, okay, sometimes we'll make money, sometimes we'll lose money. And then there's this thing of diversification. It's easy to be over diversified. Luckily, with position sizing, it limits you if it's not geared, because once you run out of cash, of which I've experienced that many times, so you will lose a lot of great setups just because you don't have cash, you see. But now, you don't want to put 1,000 rand on Sasol and then it goes up by 100%. You just made 1,000 rand. Or you can just take 15 grand and put it on Sasol and return 100%. Then you've just made 15,000. That's a lot. So now if you tell someone, don't over diversify. Yes, diversification is important to sort of manage risk and everything, but just don't overdo it. You see, yeah. So it's those expectations that you need to be aware of if you share your journey with people, the expectations. Because I mean, obviously, if I'm gonna listen to someone that has 20 years experience telling me that on average they return 20% per year, and then I meet another guy who knows nothing, who drives an M4 and telling me that he made $1 million, I won't respect that hot man. I will think there's something wrong with the hot man. But this new guy,
the holy grail of this
one. Yes. So how long can you do it? That's it.
Yeah.
But I mean, different strokes for different folks. Some people are okay with, if I die, I die. As long as they can handle it, I'm fine with it.
Oh, okay. Yeah, man. I'm so and first of all, I like what you just mentioned with newbies or new people in the market trying to be right in the market, saying I'll recover, I'm right, I know what I'm doing, and then eventually they capitulate and exit positions. I think it must have been the second episode I did with Petri Redenhays, and he made a mention of this book, Being Right or Making Money. And he made a similar example that you just did, to say the problem with a lot of traders that lose a lot of money is they go into a position thinking that they're right or believing that they're right. And when the market disproves them or negates their theory, they don't want to accept that they're wrong, because exiting a position at loss is accepting that you're wrong.
Yes.
Yeah. What's one advice that you thought was great when you got it, and with the benefit of hindsight was actually a terrible idea, or if not necessarily a terrible advice, it was an advice that does not suit neither your personality or your trading style?
Yeah, okay. It's not an advice that I got directly, but I think this thing of you lose when you sell, I don't think it's a good advice. And this thing of rent cost averaging, I mean, if you're buying in an uptrend, sure, you can buy, because not everyone has deep pocket. Some people, they get paid once per month on an uptrend. It's good. But if you are buying something that is falling, it's not good. You are just throwing good money
After bad.
after bad. But something that a concept that I got incorrectly. I don't blame the person who was sharing the concept. It's is it a Bollinger or a Bollinger Band?
Yeah.
So how that thing works, because inside the band, I think there's a moving average, and the band itself is a standard deviation.
Yeah.
So
yeah.
now this thinking of if the price is touching the upper band, then it's going to retrace back to the average and stuff like that. Or if it touches the lower band, it's going to bounce and go back. You see, excuse me, I'm not saying that a Bollinger Band is something for identifying a trend. That average in there, let's say you're using a 20-day simple moving average. If the price is trading above the 20-day moving average, that's a strong security. It's on an uptrend.
Yeah.
So why would you want to short it if it touches the upper band? You see, because yes, it can decrease a bit, but what are the chances that it will touch the moving average again? Because it can just retrace a bit, never touch the moving average, go back, touch the upper band, and move up. I think then I read about the Donchen channel. Then I realized that, okay, the Bollinger Band is something that looks like a Donchen channel, but the Donchen channel is a trend indicator. Every time the price break above the upper level of the Donchen channel, you want to buy, not to sell. You see, so my knowledge of the indicator, the Bollinger Band, it really bent my fingers, because the tool was right. It's my understanding of a tool that was incorrect. Yes. So now, well, I don't use it anymore, but yeah, it's possible. I mean, when you get information, whether you are being taught by someone who says they know how to trade, they explain the Bollinger Band the way they understand it, or whether it was from YouTube or from a website search. But yeah, it was just that one tool that I learned incorrectly. And then in terms of oscillators, the RSI, I'm not going to say that the price doesn't go back if it reaches the overbought position, but a security that is in a strong uptrend can stay overbought for a very long period of time. And the security that is falling can stay oversold for a long period of time. So don't just see that, okay, the RSI is above 70, then let me short this security. No, what if that security has, I mean, you look at the candle, it's on candle that shows momentum. Why would you want to short that? Yeah. So there are some things that you can misinterpret if you don't understand. And then I think the best advice that I got is what's the name of this guy? Not Ed Sekota, but it's losers average losers. I'm trying to remember the name of the trade. Let me see if I can quickly find it, because I have it. It's there. I mean, I have the guy on my mind. It's just the guy's name that I forgot. Yes. So, it's Paul Tudor Jones. Yeah. So, I've got it. If you buy security and it goes lower, don't add into that security. Just forget about it. It's either you exit it or you wait for the stop level to be hit, but never ever add into a loss. So that's the best advice. That's the principle that I live by. Even on my Twitter account, I have it there on the bio, losers, average losers, so that I know to never ever add onto a losing position.
Yeah. I also, I only add to my winners. I always just cut my losers short, and partly because I'm trading geared, and I can be the market can be irrational for far much longer than I can remain solvent. So that's the best advice, man. Cut your losers short.
Yes, let your winners run. That's the principle we live by in trend following.
Yeah.
But yeah, I mean, it's just that locally, there are trend followers, people who describe themselves as trend followers, but there aren't a lot of them. And then other people incorporate, okay, they are not systematic trend followers. They will have trend following, but they will also have discretionary stuff by adding fundamental analysis.
Yeah.
But I think we have a good community, although it's sort of a small community, but it's great. I mean, like I said, storm trading, I don't know what approach they're using, but I will just gonna go ahead and say they're looking at price action, and there would be some patterns. There are no moving averages.
Yeah.
So you see it works. There was another guy, I don't see him on Twitter a lot. It was a white guy. He was a painter. I think he was also an engineer, but he had a system that he was using to trade oil. That guy used to kill the market. That guy was pulling large positions. So that motivated me to look into moving averages. But there was a time where I almost quit trading because the results were not coming.
Yeah, don't you all?
The results were not coming. I mean, you see, that's why I'm saying, as a trend follower, you must look for a trending market. There was a time where JSE was just moving on the side, just the total JSE. You could still pick up individual companies that are performing well, that are trending up, because there was a time where a lot of companies were on a downtrend. But I mean, that Impala trade, I got it when most of the stocks were moving lower. So now you see that, okay, I must look at something that is trending. There's a guy in the US, Larry Tentarelli, I think. He's using pure systematic trend following. That guy is price moving averages. Then I was convinced that this thing works. I just dropped everything. Said, okay, I'm just going to look at price and moving averages. Then that is how I bounced back and came back and started to focus on just one thing and one thing only. Yeah. And since then, I think I can say October 2018, then I started to see consistent results. I started to see good profit. And I think that's what made me to say, I think now I'm confident enough to open a Twitter account or a YouTube channel and share, because we're on the market to make money. It's not about being right. If I post a chart and it doesn't work out, I lose nothing. I'm not in school in the sense that it's always about being right. I mean, you read a lot of personal development books. This encourage that we have to being right. You just want to be right. Yeah. Even when you are wrong, you want to still stick to being right. So now I just accepted that, I mean, I can engage with these people instead of following them from a distance and whatnot. If maybe, say, for example, Lester post a chart, I can give an opinion based from what I see without not being afraid to say, what if I'm wrong? I mean, if I'm wrong, I'm wrong. If he's right, he's right. If he's wrong. And that's just about it, you see. So I had that confidence to say, okay, fine, I can do this thing and stuff. So thanks to Larry, among other people.
Yeah. I mean, as
another thing. I still listen to Michael Covell podcast. I always look for where he talks about traders, because I think he's also running out of trend followers. Now there are people who talk about psychology and other things, but I listen to his podcast. I think the other guy is in Australia, Chat with Traders. I listen to that podcast. Yes, and then I will try to filter for the ones that talk about trend following or systematic approach. And then Rainer, of course, I subscribe to his channel each and every week. I always watch his videos. Even my girlfriend now, she knows that, hey, my friends. She knows that, it's that Asian guy. Rainer is one of the best, man. So I'm grateful that there are people out there who can share this kind of information and make it easier for us, because yes, I'm still a beginner. You never stop learning in the market.
Yeah.
But I'm grateful that there are people like them.
Yeah,
That make
hopefully.
it possible for us to learn as well.
Yeah, hopefully the Village Trader YouTube channel will make it into the list as well, and the podcast.
Yes, now, man. Yes, you have to grow, man. We want to see a lot of people there.
Yeah.
Yes, I mean, like people like Petri. Petri, you can ask a question. He will take his time to look at that information for you and answer you and really give you like a solid answer, not just beat around the bush and everything. I mean, on Twitter, we don't show our faces a lot. People don't know who you are. But for the fact that Petri can take his time and look at something for you and come back and give you a very clear response, explaining the concept and everything, I really appreciate that, man.
Yeah. And lastly, man, I've really enjoyed this conversation, and I'm really appreciative of your time. But before I let you go, man, please give me your favorite books, because I'm seeing that you're a book reader.
Okay, my Holy Bible is Trend Following by Michael Covell. Market Wizard, I think anything that is written by Jack Schwager is worth looking at. The 2 books by Mark Minervini. The last one, okay, it's not his third book, but the second book on trading, Think and Trade Like a Champion. That's the book. Yeah, so I think those are the 3 best books: Trend Following, Market Wizards, and Think and Trade Like a Champion. And then if you just want a bit of inspiration, the book Elon Musk by Ashley. It's a very interesting book. I read it before he succeeded in having that. Well, I'm not an astronaut, so I'll just call it a rocket. The thing that he used to transport the rocket into space, and then it comes back and lands back. Yeah. So I read that book before it happened. So when I saw it happened, man, I was excited because it was his dream. It shows what you can dream about things and they can happen, man. You just have to believe and keep on trying. Yeah, those are the books. And for people who are interested in investing, using investing approach, I think The Intelligent Investor is a go-to book, but it's thick. There's a book that simplifies it a bit. I'm just trying to look for it. It's called The 25 Habits of Highly Successful Investors. It's written by Peter Sander. So it covers everything that is there in The Intelligent Investor, but it's in a clear format. Yeah, you can see. I'm not going to blame the author. It's just that value investing is completely different to technical analysis. For example, in that book, they mentioned that when you make an investment, in addition to buying companies that have superior products, that don't have a lot of challenges like Apple and stuff, they mentioned that you must look for a company that has paid dividend for the past 5 years, I think. So there was a time where I missed a company. I think it was Kumba Iron Ore, because in the previous commodity cycle, a lot of the resource companies, they weren't able to pay dividends. So I didn't buy that company. As much as the technical said I must buy, but because of that anchor of the company must have paid dividend, I missed a good run. But yeah, those are the books. Yeah, I will just write the list and send you the list so that you can incorporate it there. I noticed when I was reviewing the Complete Title Trader, there was a bit of an issue there to say nature and nature, like natural, and to teach something, Yeah, so, our English data bundles, they get depleted very quickly.
Yeah, from time to time, they just disappear.
Yes. And the way we say things. So some things, it's better if you just write it, because it saves you from that, just to ensure that you give people the correct information. But no, man, I'm an avid reader because I've never paid anyone to teach me how to trade. Well, partly because in the beginning, I couldn't afford to pay someone to teach me how to trade. And being someone who's been in school forever, so I decided, okay, I will take the route of just reading. If I see Village Trader recommending a book, I will go and look for that book and read and see what I can find. So my trading started on the path of reading books rather than attending a seminar and learning. Yes, there are some webinars like Just One Lab.
Mm-hmm.
The information is there. You just sit and watch. Simon Brown lazy system is very clear. You just have to take your time and follow that, and then you try it, you see. But I started learning because I think it's better to know how to select what you want to buy than to be told what to buy. Because yes, today you can tell me buy Sasol, but what if you are busy? Now you can't tell me it's time to exit Sasol. And then I lose. Who am I going to blame? You see? So the people that I talk to now, I always tell them it's important to know how to play the game than to be told how to play the game, you see.
Yeah. Now, man, we'll park it here for today's episode. Thank you very much for borrowing me your time. I really, really appreciate it. Thank you for listening. Be sure not to miss another episode of The Village Trader by subscribing on your favorite podcatcher. We everywhere where good podcasts are aggregated. Thank you for hanging with us. Check you next time on The Village Trader podcast. Trend Traders YouTube channel, traders and everything will be on the show notes below. Thank you, Trend Trader, for your time. Thank you for listening. Check you next time on The Village Trader. Cheers.